Good morning. Fannie Mae predicts mortgage rates could drop below 6% by 2026. And here's what that means for investors. So, Fannie Mae's latest September 25 economic and housing outlook has sent ripples across the real estate and mortgage world. After 2 years of volatile interest rate movement, the government sponsored enterprise now forecasts that mortgage rates could finally fall below 6% by 2026, which would mark a big potential turning point for both homebuyers and commercial real estate investors. So, what are the key factors driving this forecast? Well, after the Federal Reserve's aggressive rate hiking campaign to tame inflation in 22 and 23, inflation has cooled from its 9% peak to near the Fed's 2% target by late 2024. Now, this progress allowed the Fed to cut rates for the first time since December 2024, lowering the federal funds rate by a quarter to the range of 4 and 4 and a quarter in September of this year. Now, despite these cuts, mortgage rates remain stubbornly high, hovering near 7% due to persistent inflationary pressures and investor uncertainty. However, Fannie Mae's economists now believe that the worst may be over. I like that thought. Fannie Mae's key mortgage rate forecasts. Well, according to Fannie Mae's ESR, or Economic and Strategic Research Group, 2025 year-end mortgage rate should be 6.4-ish. 2026 year-end mortgage rate should be 5.9-ish. Total home sales forecast 4.72 million in 25 and 5.16 in 2026. So we're bouncing upwards again. Single family mortgage originations at 1.85 trillion, up to 232 the next year. Right now, a GDP growth is forecast at 1.5, and it should be 2.1 in 26. Inflation 3.1 in 25 to 2.6 in 2026. So that's a good thing if inflation goes down. These numbers mark a subtle but significant shift toward stabilization, signaling renewed confidence in housing and lending markets after several unpredictable years. Now, the key issue is affordability. The main barrier is just still standing for a lot of folks. Despite the optimistic outlook, affordability continues to block many first-time homebuyers and investors from entering the market. Since 2010, median home prices have roughly doubled, while down payment requirements have also surged. Combine that with elevated rates, it really just makes it difficult for folks to qualify for financing. Now, however, if rates indeed do fall below 6% by 2026, housing affordability could improve markedly, spurring both retail home purchases and CRE investment activity. More inventory and stabilizing prices should draw sideline buyers and investors back into action. Let's go. So, what are the Federal Reserve's next moves? Well, the Federal Reserve's September 2025 summary of economic projections indicates more rate cuts are likely ahead, with the median funds rate prediction of 3.6 by year end. Chairman Jerome Powell emphasized that the Fed's path remains data dependent, prioritizing balance between price and stability. As Powell stated, labor demand has softened and job creation is now running below the break-even rate. So this cautious tone suggests that the Fed is willing to cut further if economic conditions warrant that. So, and that's really the key factor in bringing mortgage rates lower is that they see a need for it, and it sounds like there is. So, what does this mean for CRE investors and business owners? Well, commercial investors and business owners, this forecast represents a window of opportunity. So we can look at refinancing leverage. So those with higher rate loans could soon refinance into lower fixed rate structures, saving you money each month. New acquisitions, so lower capital costs, will improve cap rates and make previously marginal deals pencil again. This opened up the doors for developers too. So construction and bridge loan rates will likely ease along with these, which basically just makes less interest that goes into a project, makes projects more affordable. Portfolio growth. A declining rate environment historically leads to higher lending activity and greater liquidity in CRE markets, and usually more sales too. So, the bottom line here, if Fannie Mae's predictions hold true, 2026 could usher a renewed lending cycle, one that rewards prepared buyers, refinancers, and investors. So those who act strategically in 2025 were in the fourth quarter, look into locking financing, scouting undervalued properties, and building relationships with lenders. That way you'll be in the best position to capitalize. So here's a pro tip. Connect with a commercial mortgage advisor who understands both current market volatility and forward rate strategies. Aligning your investment timing with the Fed's next move could mean significant savings over the next cycle. Let's go. Let's go Aggies, and have a good week, everybody.